Have you ever heard of a business book that's so sought after, used copies sell for thousands of dollars? Well, that book is Seth Klarman's Margin of Safety. And the reason why is pretty simple. It's basically a masterclass in a disciplined, risk-first investment philosophy that flies in the face of almost everything you hear from Wall Street. So in this explainer, we're going to unpack its core timeless ideas. To really get what value investing is all about, we have to start with this classic story about trading sardines. It just perfectly captures this bizarre disconnect you see in financial markets. The huge gap between an asset's price and its actual, usefulness. The lesson here is simple, but it's profound. Are you buying something for what it's truly worth, or are you just betting that some greater fool will come along and buy it from you for more money later? That single distinction, well, it's everything.
So you might be asking, why does this happen? Why does this disconnect between price and value even exist? Well, Klarman argues that it's actually baked right into the DNA of the modern financial world. Let's dig into why Wall Street's goals are so often the complete opposite of yours.
This quote right here gets straight to the heart of the problem. At its core, Wall Street is a transaction business. It makes its money from activity, from commissions, from underwriting new deals, from constant trading. Whether all that activity actually helps you build wealth in the long run, that's a secondary concern, at best.
And this setup creates a massive conflict of interest. Think about it. Wall Street is incentivized to sell you products, to get you to trade a lot, and to focus on what's hot right now. This creates what Klarman calls a bullish bias, a relentless pressure to just buy because that's how they get paid. But a thoughtful investor, you're focused on the long haul, on real growth, and most importantly, on protecting the capital you already have. Those two goals just don't line up.
So this conflict forces everyone who enters the market to make a choice, whether they realize it or not. And this choice defines your entire approach. Are you going to play this game as an investor or as a speculator?
Here's how the two mindsets break down. An investor sees a stock as what it truly is, a tiny piece of ownership in a real business. So their job is to analyze that business. A speculator, on the other hand, sees that same stock as just a piece of paper, a trading sardine. Their job isn't to analyze the business, it's to try and guess what everyone else is going to do. It's about predicting psychology, not performance.
Now, this difference in mindset leads to a complete flip in priorities. Most people, when they look at an investment, they start by asking, how much money can I make? But the value investor, they start with a totally different question. How much money can I possibly lose? Starting your process with risk, not with return, is probably the single biggest step you can take onto the value investing path.
Okay, so if your main focus is on not losing money, how in the world do you actually do that in a chaotic market? Well, Klarman says you need a secret weapon. And this is the central idea of his entire philosophy, the margin of safety. And who better to sum up this whole philosophy than Warren Buffett himself, right? He learned this from the father of value investing, Benjamin Graham. And look, this isn't just some clever little saying. It is the absolute bedrock of the entire approach. The number one goal is loss avoidance, period. So what exactly is a margin of safety? It's really simple. It's the discipline of buying a dollar for, say, 50 cents. You do your homework, you figure out what you think a business is actually worth, and then you wait. You wait with incredible patience until the market offers you a chance to buy it at a big discount to that value. That discount, that's your margin of safety. It's your buffer. It protects you from a future you can't predict, from a run of bad luck, and maybe most importantly, from your own mistakes. So why is avoiding loss so incredibly powerful? The math here is actually stunning. Let's look at this. You've got two investors. Investor A is just steady Eddie, right? Earns a solid 16% every single year. Then you have investor B, a total superstar, who racks up an amazing 20% for 9 years straight. But then, in that 10th year, they hit a snag and lose 15%. Now, for 9 years, Investor B is crushing it, way ahead. But who do you think actually has more money when it's all said and done?
It's Investor A. It's the steady one. That one bad year didn't just sting Investor B. It completely wiped out their entire lead and then some. This is the brutal, unforgiving math of compounding.
Avoiding a big loss is often way more powerful than chasing a spectacular gain.
So, if the goal is to avoid losses by using a margin of safety, what kind of thinking does it actually take to pull this off? Well, it requires a deeply, fundamentally contrarian mindset.
It really comes down to these three pillars. First, it's a bottom-up approach. You're not a fortune teller trying to predict what the whole economy will do. No, you're a detective analyzing individual companies one by one. Second, you're focused on absolute performance. That means measuring success against your own goals, not just trying to beat the S&P 500 this quarter. And third, of course, is that risk-averse approach, where every decision is centered on that margin of safety.
A huge part of this mindset is getting your relationship with the market right. And the best way to think about this comes from Benjamin Graham's famous creation, Mr. Market. Imagine you have a business partner, Mr. Market. The only problem is, he's a total manic depressive. Some days he shows up euphoric, shouting about how great things are, and he'll offer to buy your shares for way more than they're worth. Other days, he's a terrified mess, convinced the world is ending, and he'll offer to sell you his shares for pennies on the dollar.
Now, here's the key. Your job is not to get swept up in his moods. You don't ask him for advice. Mr. Market is there to serve you, not to guide you. You just listen patiently to his crazy offers. And when his emotions get the better of him and he becomes totally irrational, that's when you act. You buy from him when he's panicking, and maybe you sell to him when he's deliriously happy.
Being a contrarian like this means that, by definition, you have to look for opportunities where nobody else is. The hunt for value will take you to the forgotten, neglected, and sometimes scary corners of the market.
Value is often hiding where things are messy or boring or complex. Take corporate spin-offs. They're often dumped by big institutions without a second thought, just because they don't fit some mandate anymore. Or look at financially distressed companies. Fear causes almost everyone to run for the exits. The common thread here is that these are areas that are ignored and underanalyzed, and that creates the potential for the exact kind of mispricing a value investor lives for.
Ultimately, when you put all these pieces together, the risk-first approach, the margin of safety, the contrarian mindset, it's not about a secret formula. It's about making a very conscious and deliberate choice about how you're going to operate in the world of investing.
And this really brings us to the central paradox of value investing. The ideas themselves, they're simple. Buy a business for less than it's worth. Easy enough to understand. But actually doing it, that's incredibly hard. Because it's not a test of your IQ. It's a test of your temperament. It takes the discipline to say no to almost everything, the patience to wait, sometimes for years, for that perfect pitch, and then the judgment and courage to swing big when it finally arrives.
So you're always left with this choice. Mr. Market will always be there, waving you toward that crowded, exciting, noisy road of speculation, the path of the trading sardines. And right next to it, there's always the quieter, less traveled, more disciplined path of the value investor. So the question is, which one are you going to choose?